All right, time now for the latest from the eNCA Money Desk. Ropiwa Mazena is standing by. Ropiwa, the data is showing that the economy rebounded from the social unrest-induced contraction in the third quarter of last year.
That's right, Isaah, and we're talking about the latest GDP data that's come out. So the SA economy is 1.8% smaller than it was before the COVID-19 pandemic, and that's despite the economy growing by 1.2% during the fourth quarter of last year. Now, the numbers say that 5 of the 10 industries recorded a rise in production, with agriculture, trade and manufacturing registering the largest increases. Now, South Africa's GDP is projected to grow by about 2% in 2022, and that's returning to pre-COVID-19 growth numbers. Joining me now to break down these figures further is Isaah Mhlanga, who's from Alexander Forbes, the chief economist there. Thank you very much for your time this afternoon, Isaah. So we have economic growth figures for the last 4 months of the year and for the entire year. So essentially, the economy is still smaller than it was before COVID-19. But have you seen anything positive in the figures that were released today?
Indeed, the numbers that we saw are for the last 3 months of 2021, and they come in slightly better than what was expected at 4.9%. And as you mentioned in opening, quite good growth from agriculture, though it's a small sector. Good growth also from trade, given that it was opening up with COVID restrictions being reduced. Manufacturing also, coming through there with positive growth. And there have been quite a good positive numbers, which I think we need to highlight from an investment side particularly. For the first time in 5 years, we've seen overall gross fixed capital formation turn into positive territory at 2% if we look at the overall year of 2021. And that has been driven by the private sector, to a large extent growing at 3.1% in 2021. But also, for the first time in 5 years, we have seen public corporations growing positively at 3.7%. So we had 5 years consecutively of negative growth or contractions in public corporations. This time around in 2021, we're now seeing a growth of 3.7%. But what we are seeing in general government investment is continued contraction, which is now in its 5th year consecutive. But the main point, or which is the positive aspect of this release, is that the private sector is now positive after only 1 year of contraction in the previous 5 years, which takes gross fixed capital formation positive territory for the first time in many years. And over the last 10 years, we have seen, only 3 years of contraction in the private sector, which means the other 7, it was in positive territory, which then dispels the notion that the private sector has been on an investment strike. The numbers are quite clear. It is government that has been disinvesting in the economy, particularly general government, which is essentially local municipalities, or provinces, and also public corporations that have been disinvesting. But for the first time, they've turned positive, and the private sector have also turned positive, which is a positive aspect, which talks again to what the president said in SONA. The private sector should be at the center of economic revival in this economy, and the numbers are starting to show that indeed, as of 2021, it turned positive, while public sector continued to contract.
One positive that you did mention there, Isaah, is the agricultural sector, which appears to be showing some good growth, somewhat sustained. It's a sector that can lead the way into our economic recovery. Just in terms of sectors that government should be focusing on to get those green shoots to stimulate growth, what would you say we should be focusing on? The president has previously also spoken about the infrastructure fund as well.
Look, I think over the short term, we just need to remove all restrictions that are around COVID. We have vaccines that are in plentiful supplies that people can take. So let's remove all COVID restrictions so that the economy can continue to grow and recover. Particularly if we look in terms of the trade, the hospitality, the tourism, the events, they need to go back and try to operate at full capacity. That's the much more immediate something that can be done and can be done now and can improve economic growth, not over the next year, but over the next couple of months. But beyond that, we need to see the economic reforms that have been ongoing being accelerated. The auctioning of spectrum, which I understand is taking place today or has already taken place today, needs to complete. But also we need to deal with the rail and ports. The commodity price boom or commodity price increase that we are seeing, also fueled by what's going on in Russia and Ukraine, should help South Africa's economic growth prospect. But it cannot unless if we have Transnet that is able to ship the commodities to the ports, and the ports being efficiently run such that we can load all those export of commodities to offshore markets in a much more efficient and quickly enough before this price increase reverses. So we need to see some actions there. But again, as we know from yesterday, electricity load shedding is back. We need that to be resolved. And until we resolve that, we are not going to have sustained economic growth over the long term. So we need that electricity binding constraint to be removed from the economy.
What about consumer confidence, Isaah? We are seeing that the price of Brent is reaching record levels, and that is fueling things like inflation and the higher cost of living in general. Will that not have some kind of impact on the outlook in the short to medium term of growth within the country?
No doubt the cost of living is going to have a big bearing on consumer confidence, but consumers' ability to just go by. We have oil prices that have now pierced through $120 per barrel, which means petrol prices will continue to increase in addition to the large increase that we saw last week. But we also have, if we look in terms of wage settlements, wages are not growing as fast, which means from an income point of view, just the wages component alone is also not helping. The creation of employment in the economy still remain quite weak, given that we have not yet seen significant levels of investment by businesses that can create jobs. And that holds back the ability of the economy to create jobs. So from an income point of view, consumers are quite constrained, but also from the cost of servicing debt, interest rates are going up. And no doubt we are going to see continued increase in interest rate by the South African Reserve Bank as components or factors that drive inflation upwards continue to remain in place. The supply side constraints from COVID restrictions are still there. Oil prices continue to increase, in part because of the Russia-Ukraine issues. Food price inflation also will likely increase going forward, given that Russia and Ukraine are major producers of grain and particularly wheat, which we import. So that is also going to play into the inflation outlook. So the inflation outlook that the SAB had painted at the last MPC is likely to be revised upward, which will then necessitate some more increased interest rate. And that is going to put some constraints on the ability of consumers to service their debt or even to borrow new debt, which is going to really dampen the demand side of the economy.
Isaah Mhlanga, many thanks for your time this afternoon. The chief economist at Forbes joining us to break down the GDP figures that were just released.